In today's session, we will discuss the lease accounting from the lessee's perspective. We will start with the right-of-use asset. The question is, how a right-of-use asset is measured by the lessee at the lease commencement date?
At the lease commencement date, a right-of-use asset is measured at the sum of 1. The amount at which the lease liability was recognized previously, and 2. Initial direct costs incurred by the lessee.
What if no initial direct costs were incurred by the lessee?
When no initial direct costs were incurred by the lessee, a right-of-use asset equals the lease liability recognized. The journal entry recorded by the lessee is debit right-of-use asset and credit lease liability.
How the right-of-use asset is reported in the balance sheet subsequent to initial recognition?
Subsequent to initial recognition, the right-of-use asset is reported in the balance sheet at cost minus accumulated amortization and any impairment loss.
Please give an example of how to calculate right-of-use asset under a finance lease.
Okay. On January 1st, Year 1, Salawi Abdel Fattah Company S&A entered into a 3-year lease of a machine from a lessor. S&A must pay to the lessor 3 annual payments of $100,000 starting from December 31st, Year 1. The machine useful life from the lease commencement date is 5 years. The lease agreement allows S&A the option to purchase the machine at the end of the lease term for $15,000. S&A is reasonably certain to exercise the purchase option. S&A incremental borrowing rate is 15%, but rate implicit in the lease is 10%, which is known to S&A, the lessee. The present value factor of an ordinary annuity at 10% for 3 periods is 2.48685 to be used for the rental payment, and the present value of 1 at 10% for 3 periods is 0.7513 to be used for the purchase option. The present value factor of an ordinary annuity at 15% for 3 periods is 2.28323, and the present value of 1 at 15% for 3 periods is 0.65752.
Please explain to the members how to classify the lease and how to calculate the right-of-use asset.
Although the lease term is less than 75% of the leased asset remaining economic life at the commencement of the lease term required to be classified as a finance lease, yet the lease is a finance lease because it meets the lease classification criterion of including a purchase option that the lessee is reasonably certain to exercise. The rate implicit in the lease of 10% is used to calculate the present value (PV) of the lease payments because S&A, the lessee, knows this rate. Since no initial direct costs were incurred by the lessee, the right-of-use asset equals the lease liability. The lease liability is calculated as follows. 1. The PV of rental payment equals $248,685, being $100,000, the annual rental payment, multiplied by 2.48685 plus 2. The PV of purchase option equals $11,270, being $15,000, purchase option price, multiplied by 0.7513. Thus, the PV of lease payments is $259,955, being $248,685 plus $11,270. The journal entry to be made is debit right-of-use asset for $259,955 and credit to lease liability for $259,955.
The above example is for a finance lease. We will be grateful if you adjust the example to cope with the classification criteria of an operating lease.
Okay. Using the scenario of the above example, assume that 1. S&A, the lessee, concludes that the lease is an operating lease. 2. The lease does not include a purchase option. 3. The rental payments are $100,000 at the end of year 1 and 2, and $160,000 at the end of year 3, and the rate implicit in the lease is not known to the lessee.
Since there is no purchase option, we understand that the payment of $60,000 at the end of year 3 in addition to the annual rental payments may be made to cover the amount of residual value guaranteed or non-renewal penalty. Is this correct?
Yes. Let me explain how to calculate the right-of-use asset and the lease liability for the adjusted example. Because S&A, the lessee, does not know the rate implicit in the lease, it uses its incremental borrowing rate of 15% to calculate the present value of lease payments, which is as follows. The present value of the lease payments is $267,774, being $100,000 multiplied by 2.28323 plus $60,000 multiplied by 0.65752. The journal entry is debit right-of-use asset for $267,774 and credit lease liability for $267,774.
Based upon the example where lease was classified as a finance lease and the adjusted example where the lease was classified as an operating lease, how the right-of-use asset is amortized.
In the example where the lease was classified as a finance lease, a purchase option exists that the lessee is reasonably certain to exercise. The right-of-use asset is amortized over the leased asset's remaining useful life of 5 years. Annual amortization is $51,991, being the lease liability at the lease commencement date of $259,955 divided by 5. The journal entry to record the annual amortization is debit amortization expense for $51,991 and credit accumulated amortization on right-of-use asset for $51,991. As to the lease classified as an operating lease, since neither a purchase option exists nor ownership of the leased asset is transferred to the lessee at the end of the lease term, the right-of-use amortization period is limited to the lease term of 3 years. The annual amortization is $89,258, being the lease liability at the lease commencement date of $267,774 divided by 3. The journal entry to record the annual amortization is debit amortization expense for $89,258 and credit accumulated amortization on right-of-use asset for $89,258.
The session is up. We will continue to discuss this accounting standard in the coming sessions. Thank you.